What is going on in the markets, guys? The VIX spiked 55% since the Fed cut. Oil jumped to almost $80 a barrel. And the weirdest thing of all is that bond yields are skyrocketing despite the Fed having cut. Aren't bond yields supposed to go down? And more importantly, are all of these signals here, are they just a big warning sign telling us to get out of the market? Because this is what tends to happen when the Fed initiates a cut after the fastest rate hiking cycle that we've seen, right? We've seen in all the charts in 2008, once the Fed cuts, the market tanks. In 2001, once the Fed cuts, the market tanks. Lucky for us, I'm going to be answering that for you here, give you a market update for October, and explain why bond yields are rallying. And more importantly, what opportunities we could take advantage of, because with such extreme moves, there are asymmetrical opportunities, in my view, for us to take advantage of. So I'll give those to you towards the end of the video, but let's get right into it. What is going on here? So as I said, the VIX has spiked 55% since the Fed cut rates. It was at 15 and then it hit a high of about 23. As of the time of this recording, it's at 21.5. Well, believe it or not, this is what I posted on September 29th, before October. I said the VIX loves October. October 2023, VIX spiked to 23. 2022, VIX spiked to 34.5. Before that, 25. Before that, 41. This is really significant. I'll tell you why in a second. Before that, 22. Before that, 29. With the election plus uncertainty in the Middle East, I'd be nuts not to open a net long position on the VIX next month. And yes, I do have a long position on the VIX. That position is already up 52.5%. Those of you that were in the trading floor got the exact trade, but those of you that were following me on X and on Instagram got the analysis as well. So you could have formulated your own trade. Follow me on X and on Instagram for daily trading and finance content. But the reason that this is significant is that especially in election years, October tends to see a spike in volatility. And here's something else that I shared with you before. October is by far the worst performing month during election years. Outside of election years, not so bad. During election years, it is the reddest month out of the entire year. Now, the good news, and we'll save this for later when I talk about the stock market, November and December tend to be okay months. So because of the pre-election volatility that we normally get, the uncertainties in the Middle East, and the fact that rate cutting cycles are very dangerous times to invest, at least that's how the market perceives it. Now, why is that? Well, first, let's talk about bond yields. Why are bond yields spiking? You can see here, this is when the Fed cut rates. This is the 10-year yield. This right here, September 18th, is when the Fed cut rates, and bond yields have spiked. The 10-year bond went from 3.6 and change to above 4.05. Why is that? The Fed already cut rates. First and foremost, we have a sell the news event. So this is the bond yield, right? Let's pull up something that represents bond prices like TLT. You can see here that TLT has been going up steadily since April, because this is when the Fed first signaled that they were going to cut rates. So this right here is just a typical sell the news. Just like we can get sell the news events with stocks, we can get sell the news events with bonds. As a matter of fact, this is when the Fed cut rates here. So obviously, if bonds were rising in expectation that the Fed was going to cut rates, then we're going to see some sort of profit taking on bonds. And this profit taking on bonds is what causes yields to spike once again, because as bonds sell off, the yield goes up to make them more attractive. Remember, there's an inverse relationship between the bond price and the bond yield. Now, let's go back to talking about why this is a dangerous time, in my opinion, to invest, and why we see a lot of volatility once the Fed starts cutting rates. Because once the Fed starts cutting rates, the market becomes the most sensitive to news. And yes, you might think that the market is very sensitive to news as it is, but nothing compares to how the market reacts when the Fed starts cutting rates. Let me give you an example. So the Fed started cutting rates. We got good jobs data, even though I think this data will be revised later. That's for another video. But we got good jobs data. So last week, as at the time of this recording, the unemployment rate came in less than expected at 4.1% versus 4.2% expected. And non-farm employment rate, meaning the number of non-farm jobs added, 254,000 versus 147,000 expected. So seemingly many more jobs added than expected. What does that signal to the markets? As you can see here, that signals to the markets that, oh my God, the Fed might actually do a soft landing, which means, oh my God, the Fed, now that unemployment has actually gone down and we've added more jobs, we don't need to cut rates aggressively. So this is why you are now seeing the probability of a 25 basis point rate cut for November being the highest, as opposed to a 50 basis point rate cut. That's not even on the table anymore. Just a week ago, there was a 37% likelihood, or at least that's how Fed funds futures traders were betting, that the Fed would cut by 50 basis points. Now, overwhelming majority say that the Fed will do a 25 basis point, and there's even a 13% chance that the Fed won't cut at all. Now, we have CPI being reported on October 10th. The forecasted CPI is 2.3%. What do you think happens here if, say, CPI comes in at 2.6%? Well, obviously, that is going to scare the market because it's going to signal, hey, inflation is coming back. There's no way the Fed can cut. So all of a sudden, we're in a position just off of a news release where the market expects the Fed not to cut. And so bond yields are going to spike once again. Now, what happens if CPI comes in better than expected? Well, the Fed is then going to say, okay, we're winning on inflation. We can justify a bigger cut. Now, let's follow that path. The Fed cuts, right? What if the Fed cuts and then inflation comes roaring back? You might say that's impossible, but we've seen that time and time again. What if inflation comes roaring back? Well, then the Fed cannot cut any further. Matter of fact, now they have to consider raising. So there's this inextricable relationship. Now, once the Fed starts cutting, there's an inextricable relationship between the data and what the Fed can actually do. Because as the Fed cuts, remember, rates are still high-ish compared to where they were. And so unemployment numbers can accelerate higher. Or as the Fed is cutting, inflation can come back. And so it becomes this sort of impossible balancing act that the Fed has to do. And most of these scenarios end up with us in a recession, right? If inflation comes back roaring and the Fed's already cut, well, then if they try to raise rates again to combat that inflation, well, yields are going to go crazy. And when yields go crazy, that is going to cause turmoil in the economy. All while the market is here at all-time highs. This is why, to me, even if you're not thinking of selling stocks, to me, all-time highs where we are hovering at right now, with all of this stuff going on, right, with this sort of tit for tat that is occurring between Fed policy and news releases, this is essentially what, you know, throws us into a recession. Before the 2008 recession, we were at all-time highs. Before the 2000 recession, we were at all-time highs. So when we have this sort of, and I'm not saying don't ever invest in all-time highs, even though I typically don't make a habit of it, but we are not in a normal environment here, right? And by normal environment, I mean a period where we are not exacting Fed policy or aggressive Fed policy, whether it's cutting or raising, right? So if you look at, for instance, between 2009 and 2020, there was no major Fed policy. The GDP was trucking along. The economy was trucking along. Unemployment looked fine. Inflation looked fine. These are normal times to invest. Most of the time, you shouldn't be scared to invest. But the one time that I personally, and you could do what you like, but the one time that I don't like to deploy new cash is at all-time highs when the Fed is messing with aggressive rate policy. Because as I just described to you, it is such a blunt tool that, you know, either unemployment ends up spiking or inflation ends up coming back. It never, ever results in a soft landing. Now, before I get into whether I'm going to be selling my stock or when I'm going to be selling my stock, I want you to take a look at something here as it relates to bonds, because I believe that there is an opportunity in bonds here. This bond sell-off, as I said, to me so far looks normal. Yes, we had strong jobs data, but this is typically what we see after a sell the news event where the market was expecting the Fed to cut. The Fed cut, and so people started selling off their bonds that they made a boatload of money on since April, right? But also after Fed meetings, look at how the market reacts after Fed meetings. The market sells off its bonds after Fed meetings because a lot of times the Fed is telegraphing its move. We know whether the Fed is going to cut or pause or whatever, right? And so the sell-offs after FOMC meetings, these red bars here are FOMC meetings. This is a very normal thing, right? And so to me, this sell-off here represents an opportunity in bonds. So towards the end of the video, I will talk about the plays that I'm looking to make on bonds. And I just want to pause real quick here and say whether it's the VIX trade, whether it's our Tesla trade, whether it's this bond trade, whether it is the day trades, I go live every single day at market open. If you want to trade live with me and you want to get all of my insights, click below 7 days for free. Not only will you be able to trade live with me, it is the best show that's not online. Not only will you be able to trade live with me every single day at market open, but you get access to all of my long-term and midterm insights as well. So come trade live with me, 7 days for free. Click the link below and I'll see you there. Now, in terms of whether I'm going to sell my stocks, I know I talked about once the Fed cuts, then my eyes are going to open up a little bit more to the possibility of selling, right? Obviously, every portfolio is different. Every cost basis is different. Everyone's holdings are different. Everyone's time horizons are different. So there isn't a general when to sell, right? Like I first bought Apple when it was $20, $25, right? If you bought Apple at 200, we're going to have a very different decision to make. So I generally like to shy away from everyone should follow the same rule. I don't think that exists in investing. But if you want my insights, right, I think that, you know, in general, October is going to be a volatile month. Historically, during election years, it is a very volatile month. So I do expect some volatility, but November and December generally bode pretty well in election years. The other thing that I'm keeping my eye out on are the yield curves. Now, you can see the 10-year, 2-year just uninverted recently. 10-year 3-month is a little far away from doing so, and we need that to come along for the ride before we see a recession. Now, in the last few recessions, 2020, 2008, and 2001, the minute that the 10-year 3-month uninverts, we get a recession. If we take this back to the 80s, it actually takes a while, right? So back in the 80s, when we uninverted, it actually took us 7 or 8 months before we got a recession. That is not the case in the last 3 recent recessions, but my ears and eyes will definitely be perked for when this uninverts. So for me, I'm honestly just going to sit tight, most likely, until that yield curve uninverts, right? And October, I do expect some volatility. November, December, as long as that yield curve doesn't uninvert, I do expect it to truck along as usual. Now, in terms of bonds, I do see an opportunity here. I did send out an alert in the trading floor for a dollar cost average point on, even though I don't personally hold leverage ETFs like TMF for a long time, but this is definitely a dollar cost averaging point for TLT. You guys know, those of you that join the lives always ask me, when should I buy TLT? When should I buy TLT? And you guys are asking me when it's, basically at near highs. But I knew that we would likely get a sell the news effect on TLT. And for me, this right here at support, almost oversold on the RSI, but at support, and if you take a look at the long-term charts, you can see here that we are in a monthly fair value gap. If I'm right that this is just a sell the news event here, and this was an overreaction due to 1 month of strong jobs data, then the bond yields should actually start going down, which means bond prices will start going up. The only thing that can throw a wrench in this is what happens with CPI. If CPI comes in much higher than expected, that, like I said, I think that is the one scenario where the bond yields will actually spike like crazy and where bonds and treasuries and bond funds like TLT will actually tank. Because if inflation goes up, then the Fed cannot possibly think of aggressively cutting rates. And if the Fed is not going to cut rates, then people are going to sell their bonds because they're expecting rates to go up. The more they sell their bonds, the more bond yields will go up. The more bond yields go up, the more bonds and bond funds will tank. But let's say that unemployment comes in much higher than expected, then the Fed is going to have to cut aggressively, which would then raise bonds. If we don't really see any bad data and the Fed just keeps trucking along with cuts, with irregularly scheduled cuts, then this will go up as well. Like I said, the only wrench, in my opinion, is if inflation comes back roaring and unexpectedly, and then the Fed's hands are tied. But as long as the Fed's hands are not tied, then I think that this right here is a buyable point for bonds, in my opinion. In terms of stocks, I'm not really making any new buys here. I did buy Tesla a while ago. The last thing that I bought was Nike in the 70s. When we had a dip post the last earnings. And I'm looking to establish long-term positions on gold as well as oil on major pullbacks. I also day trade gold and oil almost every single day. So like I said, come trade live with me. But I'll reiterate, this is my worst or my least favorite time to invest in the indices. So I likely will not be buying indices here or any of the Mag 7 stocks at these prices. Anyway, traders, that is it for this video. Let me know what you think below. Do you think that we are going to get a soft landing? Would really love to hear your opinion. Do you think that the bond yields, the pullback on bonds and the spike in bond yields, do you think that that is temporary? How are you positioning yourself? I would love to hear from you. Let me know in the comment section below. Are you selling? Did you sell already? Are you looking to deploy fresh cash here for some reason? Would love to hear your opinion. Let me know in the comment section below. Click below to join me live 7 days for free. Come trade with me at Market Open every single day. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.